trading on this Monday, which will, of course, be the last few days to round out the month of August. And with that in mind, I got to bring in our guest. This is Thomas Hayes, everyone. He is the chairman and managing member at Great Hill Capital. Tom, welcome to the Open.
Thanks for having me, Corey. Glad to be here again.
Well, we are definitely glad that you are back. I want to take a quick look back, though, if I can, to last Friday, because boy, oh boy, did that send shockwaves throughout the market when JP announced that they were going to continue plans to raise rates. Of course, that next rate hike is supposed to be happening in September. He's trying to get inflation in check at the 2% annual goal. Of course, they say anything more than 2%, the economy could be overheating. Well, we're beyond overheating at this point. We're just completely on fire, and not like in the good way it's getting hot here in Nelly style, just we're out of control. Were there any other key takeaways, though, that you took from Jerome Powell's Jackson Hole speech?
Yeah, well, Corey, I was so worried about what he said that I went out to go play 18 holes in the afternoon. I have to say, this is just a continuation of jawboning. This is a strategy that's been very effective, and it's brought in demand. It's brought down inflation, and it's going to continue to work. The strategy since March has been to talk hawkish and to act dovish. If you think in the scheme of things, when inflation was running at 8.99%, to have a Fed funds rate at 2.25, if they were serious about crushing inflation, they could do it overnight and raise the Fed funds rate to 6 or 7%. They haven't done that, and there's a few reasons for it. Number one, they don't want a depression. Number two, the debt servicing. When you consider that we have 125% debt to GDP, every 1% hike increases the U.S. deficit by about $285 billion a year. So jawboning has been very successful to anchor inflation expectations, and the Fed is more worried about expectations than actual inflation. And looking at 5-year break-evens, they're just at 2.73% right now, which is totally acceptable. The other thing you have to keep in mind with debt to GDP at 125%, they want to tame that just like they did post-World War II. The last time debt to GDP was at 125%, a lot of borrowing to fight a visible enemy. This time we had a lot of borrowing to fight an invisible enemy in COVID. But they were able to bring down debt to GDP to 63% within 5 years following World War II. And the way they did that is they ran inflation above trend, 3 to 5%, which I think is exactly what's going to happen here. They'll keep talking 2% to anchor expectations, but they're going to let it run a little bit hot to bring that debt to GDP and inflate some of that away.
Tom, I like how you gave us a whole history lesson in there as well. You also dipped into World War II, where we've been at, talking about JP being very hawkish in his comments, but when it's time, they're actually being a bit dovish. But the markets, you're saying that they're, people are already pricing in certain things, but I don't know, because what happened on Friday with that 1,000-point drop, it's like, were they pricing in what he was going to say ahead of time? Because if they were, then would we have seen such a sell-off?
Well, two things. Number one, it's Friday afternoon on in the middle of summer. There are other people like myself out playing golf. Number two, the market had a monster run that caught people offside since June. The S&P rallied some 18 some odd percent. The NASDAQ rallied a lot more. The market was looking for a reason to consolidate. I think it was also looking for a reason to take out some of the Johnny-come-latelys who didn't believe the rally for the first 2 months and had to chase it at the top. So this is natural and this is healthy to punish the latecomers. We could consolidate sideways for another couple of weeks before taking the next leg higher. But what's more important than Jackson Hole, and I said this publicly before Friday, is going to be obviously the jobs report Friday, which could seriously come in positive, which would not be good from a dovish standpoint. But more than that is the PPI and the CPI numbers coming in on the inflation front, and we may have gotten a preview of things to come on Friday with the core core PCE numbers coming in lower than expectations. I think when he points to the data moving forward, if the CPI and PPI can continue their trend and show that it peaked several months back, I think 50 is the number. And we heard from Philly Fed Pres Harker said there have been 86 hikes since 1983. 75 were under 50 basis points. 75 basis points is highly unusual, and 50 basis points is still substantial. That coupled with Kansas City Fed President Esther George said lags from policy are long and variable. So the implication is they want to see the lagged effect of the recent 75 basis point hikes before going too aggressively on more 75 basis point hikes or too aggressively on the quantitative tightening schedule. And when I say that they talk hawkish and they act dovish, looking at what they've achieved on quantitative tightening, and yes, it's set to speed up a bit in September, but to date, they've only done 1/3 of the quantitative tightening that was scheduled to be done by this point. So they're 2/3 incomplete, and everyone knows QE is the Hotel California. You can check in, but you can never leave. The ECB found this out the hard way. Hedge funds are now more short Italian periphery bonds than they've been since 2008. And guess what? The ECB is back to quantitative easing. They have a facility under a different name to buy bonds in the open market and stabilize those markets, coming to a theater near you. So I don't think they want to get too tight too quickly. Jay Powell got a rude awakening when he first was appointed as Fed chair in December of 2018. If you remember, they almost collapsed the market on Christmas Eve. Steven Mnuchin had to step in and call the banks to salvage everything, and then they reversed course and pivoted overnight. So whether he wants to repeat the same mistake twice remains to be seen, but my sense is he wants to see the data come down so he can move at a more gradual pace and be much more realistic this time.
Tom, my goodness, you are giving us lots of one-liners to live by. QE is the Hotel California. You can check in but never check out. My goodness, that is a quotable. We should put that somewhere on the public app. I really want to turn our attention, though, right now to China for a second. I did give some earnings from a very strong Chinese e-commerce giant, Pinduoduo, earlier today. But as we know, there have been a lot of strains between U.S.-China relations. However, they did settle on a deal to allow U.S. regulators to see Chinese company audit records to stay listed on U.S. exchanges. Are there any delisting fears in your mind, or should they be over? Is there anything else investors should keep in mind when it comes to what exactly is going on between Chinese companies, possibly continuing to delist from U.S. stock exchanges?
Yeah, this is going to be one of the greatest opportunities for the next 6 to 18 months in our view. One of our largest positions is Alibaba. We've been consistent buyers on weakness. And, the PCAOB and the CSRC came to an audit deal last week. The PCAOB, U.S. regulators, will go to Hong Kong in the middle of September to start their first inspection of the audit papers. They've already delisted the state-owned enterprises. We saw about a handful of those delisted a couple of weeks ago. Any remaining SOEs will be delisted because of the government ownership, but it paves the way for all of the private businesses to remain listed in the most highly liquid, deepest markets in the world, which is a good thing for China. It's a good thing for U.S. banks. It's a good thing for U.S. shareholders. Our ownership of Alibaba was never predicated on the fact that they remain listed in the U.S. or they don't remain listed in the U.S. We own it in Hong Kong. We own some derivatives in the U.S. They're fully fungible. I mean, Tencent has had their primary listing in Hong Kong for years, and they're up 3,500% since 2009. So it's not the end of the world if it just became a Hong Kong listing. But it was an overhang on the stock. And in the case of Alibaba, they're going to do the dual primary listing anyway. They'll keep the U.S. and they'll have a Hong Kong. That's going to open up the stock connect. And if you look at Tencent, Tencent has about $30 billion of ownership from mainland China. Alibaba has never had that luxury because they didn't have a primary listing in Hong Kong. I think institutions are going to start to front run that demand, which is going to come at the end of the year when that primary listing is complete, because they're going to see 20, 30, 40 billion dollars of capital that have wanted to own Alibaba for years and years are now going to finally have the chance, and money's going to flood in, and smart institutions in the West are going to get ahead of that and take advantage of the new buyers. So we like that. We like the fact that Pinduoduo, look, every day last year you saw crackdowns, bad headlines, slowing growth. every day in the last month, 2 months, you're seeing stimulus, reverse course, regulation easing, no shutdowns of major cities since March and April. So COVID zero, they're a little bit more lax on. Everything's pointing in the right direction. And then finally, you had this weekend, McKinsey come out with a report that China's public cloud market is going to triple by 2025 from 32 billion to 90 billion. Well, Alibaba's got 36.7% of that market compared to Tencent, which has 11.1%. This is going to be a monster business. Think about owning Alibaba, think about owning Amazon in the United States at a 66% discount, just beginning their growth curve in AWS. People would be like, that's an absolute no-brainer. But because this has a China label and sentiment is despondent right now, no one has wanted to touch it. But, price solves that. Opinion follows trend. You see Alibaba up another 20, 30, 40 points. Everyone's going to be chasing in.
Yes, everyone will be. But you know what, Tom? We are grateful that you took some time out of your day to come share your insights with us. Everyone, once again, this is Tom Hayes. He is the chairman and managing member at Great Hill Capital. Thanks for joining us.
Thanks, Corey.